Here's what's coming up on today's show.
And we're going to have a little fun this week. We're going to play some agree or disagree with Craig and Jennifer. I've got some various statements here we're going to go through and let them debate pros and cons. I know Craig can say definitely maybe to almost every single one of these.
So non-committal, I tell you.
But
I
we'll
plead
see.
the fifth.
We'll
I
see if we
never
get.
neither confirm nor
That's right.
disconfirm that.
That's right. But we'll get him to give us at least pros and cons either way. I know it's going to back him into a corner a bit, but we'll have some fun with that.
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
So obviously, guys, what's going on? How you doing this week?
We're doing good. When you leading off with agree or disagree, I think of the 60 Minutes episodes where they do point, counterpoint.
I almost said it.
So,
Yeah.
so we'll see how the married couple, Craig and Jennifer, do on this agree and
there you
disagree.
go. That's right. You guys,
Differing opinions.
you guys don't always agree or disagree, right? You're married,
100%
right?
We
of the
don't,
time we
yeah.
do not.
This is our 35th wedding anniversary year.
Well, kudos and congratulations.
Yeah.
That's awesome. Well, all right, agree or disagree. Craig doesn't pick up, in the kitchen the way he should. No, never mind. I won't get you into trouble there. Let's do some financial stuff here, guys. Pay off the house. Here's the thing. If you listen to the phrasing of these questions, there's going to be a key word, in my opinion, that kind of changes it. You should always pay off the house as soon as you can. Agree or disagree?
Disagree. Let me give you how you should think about it. Now, going into retirement, so there's a preface. If you have a debt, like a mortgage, that eats away on what you have for income. So from that perspective, it kind of stinks to have a mortgage going into retirement. The other side of it is if you take the time. So here's the shameless plug. Come see us a little early. Don't wait until you're 65 and 6 months and then say, hey, let's go do some retirement planning. Let's do this a little earlier,
right.
50, 55, so that if you want to be done by 60, 62, 65, we can make sure that we can show you the number to get that payment knocked off. Mm-hmm. Because the mortgage companies will take extra payments. Mm-hmm. The money that you pay above the cost of the interest goes to principal. So, okay, if you've got 7 years left and you've got $100,000 left on your mortgage, we can show you what it takes to eat it up in 7 years. And that way it is paid off. The mistakes I see are people going, man, I got $200,000 in my 401k. We didn't make much money the last 2 years, so I think I'm just going to pay the mortgage off. And I go, please don't do that. Mm-hmm. And the reason why is do this math. If you're not driving, listen to me. Let's say that you wanted to keep $100,000. And the only reason I'm doing this particular set of numbers is I don't have to write it down and figure it out. But if you needed to take $100,000 to pay off your mortgage, as an example, and you took it from your 401k and your tax bracket was 20% federal and 5% state, that's 25%, you would have to take $133,000 and some $333.34 out to cover your taxes to keep the $100,000, meaning that you paid 33% right up front. Although it says 25%, it costs you $33,000 to pay off a $100,000 debt. That's bad math. Very few times would I ever say do that. So it's better to have a schedule and say, I can be done by this date. Other things, let's say your cash flow's fine. Let's say you're not going to be in this house but about 2 or 3 more years. You're going to downsize. Well, my goodness, don't pay it off. You have a mortgage. When you sell the house, the difference will just come to you, and it'll be the same exact set of math numbers as if you paid it off early. That's not a liquid asset, a house. I know that houses are selling pretty easy right now, and you might think, well, I can get my money back out of it, but that's not a guarantee. If you have the money in the bank, I can just pen a check. That's my money. I can do what I want. If you're trying to say that I can put it in a house and then turn around and resell it, what is that? It's a definite maybe, right?
Mm-hmm. Okay.
So
definite maybe.
Make a good decision with that money. I'm all about no debt. Don't misunderstand my comment.
Right.
I'm saying that you need to look at the situation and be sure that you've approached it the right way.
Okay. All right. Now, this first one, how about individual bonds are better than bond funds?
Well, it depends again. You're talking to a man who loves to buy individual bonds. I like them. And why do I like individual bonds? I know when it's going to mature. I know exactly what it's going to pay me in interest. And as long as you buy quality, you're just going to get your payments and get your money back at the date they mature. So what's wrong with that? So if you buy enough of them to have diversification, not just one bond. So corporate bonds will pay a little bit more than treasuries, and that kind of stuff. But at the end of the day, what you're looking at is cash flow and how many of the variables can I control? Now, in a mutual fund that buys bonds, you've got tons of diversification. They'll have hundreds and hundreds and hundreds and hundreds of different bonds in there, all with differing start dates and end dates. And it's not bad, but what it is less controllable. You know less of what's going to happen inside those bond funds because there's just so many of them. If you look back to 2021, 2022, when they raised interest rates and the bond prices pummeled, that really hasn't happened in 30 or 40 years, but they got pummeled in that period of time. And so that was because a long period of time, about 14 years of no interest rates, really, remember, zero interest rates, ZIRP. We didn't get paid much from 08. And then all of a sudden, this guy raises interest rates 5, 6, 7 times. What happened is the price of the bonds went down because the interest payment that had already been set when it was issued was real low. So, I mean, I like owning the bonds, but there's no straight answer. You're not going to own bonds in your 401k. You got to buy a mutual fund that does that.
Gotcha.
Maybe you don't have a whole bunch of money to put there. Mutual funds give you diversification, whereas buying one bond really doesn't give you any diversification. There's a lot of variables there. You just have to sit down with someone like me, hopefully us, and we'll walk you through the pros and the cons of it. And it makes more sense once you have, all the understanding.
Okay, very good. Jennifer, let me throw you one and get you in here on this a little bit. Nobody needs life insurance once they've retired.
Well, I love these nobodies and always and that kind of thing.
Right.
So in general, you need to look at your situation. What's the reason you have insurance? Insurance is to cover a risk, something that you don't want to be out yourself. And so you basically purchase a policy from an insurance company to cover that risk. You do it on your home. You do it for your health insurance. If you might have disability insurance, because if that happens, you want to make sure that someone's going to pay you a paycheck when you're disabled. Life insurance is very similar. So what's the reason you bought the insurance? Was it to put the kids through college and now they're not there? They've already, graduated. Was it to pay off a mortgage? Well, the mortgage is no longer there. Are you doing it to cover an income stream if you are no longer working? Is that still the case? Because maybe you've already worked and now you've got the pension going and that's, you're covering your spouse in that regard. So in those cases, maybe you don't need it. Other reasons you might have insurance, maybe you want to level the playing field for inheritance for your children. Maybe one child, inherited the business and you want to make sure that the other child, has some assets and legacy from you, so you keep that life insurance policy. So it really depends upon the purpose of the insurance, and then is that purpose still valid? That's really, I think, what it comes down to. Craig, would you agree? Are there other things that you would consider?
Just in generalities, you survived. You didn't die early, so you didn't have to be there to put the paycheck into the savings accounts and pay off the house. Okay. Then the other part would be, do I want to leave a legacy, like Jennifer said? Always important to look at that, because either it's I'm spending my last dime. Okay, I can live with that. Or, I'd like to leave something to my kids or my grandchildren, and be a part of their lives once I've passed away. That's a very, very important thing. What's the least cost to do it? If you want to leave $500,000 to them and there's 2 kids, here's $250, here's $250, or you're making a premium payment of a couple $1,000s a year and here's $250 and here's $250, which is the better economic choice. It's just look at it and make sure that we've thought about it. And that after we've made all the decisions, it's like, this is the best decision for me. That's the way you should do anything. Get it down on paper and evaluate what you really want that to do now that you're at the point in the life where you are.
So I think he agreed with me.
Sort of. I wasn't going to really
I think
agree
he
or
agreed,
disagree.
yeah.
No, not really.
Let's squeeze in one more, because this
Okay.
is my favorite question, and that is, it's better to have a fee-based advisor instead of a commission-based broker. And
Wait. I'm a fiduciary.
You're a fiduciary. So you hear that term a lot. I'm a fiduciary. What does that mean? Well, legally and in our profession, that basically means that you are a fee-based advisor. If you're a fee-based advisor, you can say you're a fiduciary. And why is that? I don't know. It's just the regulatory board says you could do that. But basically, fee-based, meaning I'm going to take your assets and I'm going to manage those assets based on your risk and return and what you want for a fee. That's the fee-based advisor. The other is a commission-based broker, and they're registered differently. And they have, they're going to basically buy and sell things for you. And when they do that, there's a commission, there's a charge.
Yeah,
okay?
It's the basic concept of why don't I hear from somebody unless they want me to buy or sell something, right? Exactly.
That could be.
Yeah.
Or you never hear from them because they're on fee-based.
Okay, all right.
But we think it's important, and why we have purposely structured our firm with both options. Why do we do that? Why do we have commission-based options and also fee-based options? Let's say your mother or father or whatever, they've got this low-cost basis stock, Apple, whatever, and it's not going to be sold because it'd be huge tax ramifications.
And they want to keep it.
Okay.
Or let's say you've got stock that you don't want to keep because you've got this, this love of this stock. You worked there and whatever, you don't want to sell it. Why put that particular stock on a fee based and pay fees? And because there's no management of it, you're going to keep it. We would put that into a commission based account because we're not buying and selling. It's a way to have the asset. Yeah, park the asset. We're actually managing the assets that need to be managed, and we park the assets that don't need managing at the time. Right?
But let's say over a 2-3 year, let's use $1 million as an account. So you got $1 million, and you do a 1% management fee on there. There's $10,000 going out in fees. Okay, so all right, if you're not doing anything in there much. Let's say you just bought some bonds as an example. Should you pay 1% on a bond portfolio that pays 5.25%? Probably not. You should probably just buy the bonds. But if there's active management, you are identifying an investment and you're saying, here's my target price and you're going to sell. Yeah, you got to look at what the average cost for doing all of that transaction would be on the commission side and say, is that the best choice or not? Fiduciary means I am compelled to act in you, our client's best interest. So I will say this, a certified financial planner has as part of an oath that they sign that they will act in their client's best interest at all times. So I have a bias to CFPs because they have to do that. That doesn't mean that other people don't do it, but it's you lose that designation, it was hard to get. I'll put it that way.
Annuities are a ripoff. Probably brought to you by the fellow that says, I hate annuities and you should too.
Well, it's a good pitch, I'll tell you that.
Right. So what do you think here?
That's a hard thing to say. Annuities are nothing more than a tool. And what happens underneath the hood is very important. Think about this. Let's say that you had $100,000 and you want to make 5.5% for 5 years and you want it to compound daily. And at the end of 5 years, you're happy with that and you'll take your money and run. They make annuities that absolutely do that. They have no fees. They pay the interest compounded daily. You get your money. No fuss, no muss. So is that okay? Yeah, it sounds okay. But then you look at other types of annuities. So I'll switch from the most simple one that I just explained, a fixed interest annuity, and then let's go to the variable annuity. So underneath the hood of this tax-deferred investment, you are able to pick a mutual fund or get some sort of indexing strategy. It doesn't have total guarantees on it, but a lot. And okay, if it goes up, I make money. And if it goes down, I lose money. Not so good, kind of that. So what do I gain in that? You might gain a death benefit. So if you wanted to put something in a very aggressive portfolio and hope that it goes up a whole lot, they also typically have a death benefit. So you put $100,000 in it. You were in 2008. You lost 57% of it. So you're down to $43,000. You walk out to the mailbox, open the statement, have a heart attack and die. What does your spouse get? $100,000. That's a pretty good deal, right? So not all bad, but the other side of it is they're very expensive. You pay for the mutual funds. You pay a fee called mortality and expense. If you put an income rider on there, you'll pay for that too. You could be up to, I don't know, $3,000, 4% of cost that is taken out of that thing every year. So, okay, do I like that or not? The other ones are these fixed indexed annuities. A lot of people on the radio do those. So what is that? Again, it's a tax-deferred wrapper. You have an investment engine that says, okay, we'll put it in some sort of indexing. You don't put it in the actual index, but you do an indexing strategy that says from one point to another, and typically it's either 1 year or 2 years, we will measure how well that index did and give you a participation in that. It might be all of it, it might be more than all of it, or it might be a percentage of it. And so if it goes up, fantastic, I make money, I keep it, I like it. But if it goes down, I stay even, so I don't lose. A lot of people like the idea of that, but then a couple of years of negative returns in the markets and you get zeros every year and you get like, I say ain't no good. So you've got to ask yourself, well, I mean, I'm just telling you what people say. So, okay, that's just the investment part. Where I really like these annuities is this. Let's say that you're going to retire and it's 10 years from now, you're going to need this money. And for simple terms, let's say I just did one of these. $285,000 is what you give me. And in 10 years, I can get this insurance company to promise you and your wife that the worst payment you're going to have is $30,000 a year. Okay, how long before my break even? Could I have done any better? And you can kind of run the math on it. But you don't lose the money invested, but you do get the income promise from a substantial life insurance company that says, based on this contract, we're going to pay you this and we will not quit paying until you pass away, regardless of whether that money survives you or not. Is that worth it to you? It might be in the grand scheme of things, and you should consider it if it fits for you. So an annuity. But at the base of it, they're neither good nor bad. They are a tool, and the person that's using the tool is the one that you're counting on to do the right job. Best interest of your client.
And the other thing let's look at the percentage of money put in annuity. I mean, we would never recommend 100% of your money in annuities, whether you're diversifying your annuities.
Right.
Because, I mean, it's a static contract, whatever, right? So what would be kind of our rule of thumb?
Well, let's say that you wanted downside protection. That would be the fixed indexed or the fixed interest annuity argument. I can't lose any money. I can make some money. I like that idea because I don't make any more money. I'm retiring. So rule of thumb would be perhaps no more than 30% of your liquid net worth. Might be a good example. You know, if somebody says, oh, you got $1 million, let's put $1 million in there. No, that's not a good choice.
Run the other way.
You have a surrender charge. You have costs to get out of these things. You might not make any money. Liquidity and different things are things that you should look at. There's another guy on the radio that I really like. I can't throw names out because I don't want you to go to him. I want you to go to me. But he always talks about a bucketing strategy. I like him. He's good. And he says you got to have your safe. You've got to have your income, which I call your income producing, your chug and plug account, and then you need to have your growth. Where does your investment fit in there, especially for the income piece? If you think about it, I'll use my same example that I gave you, $285,000. Now, it cooked for 10 years. I understand that. But at the end of 10 years, based on the original investment, I'm giving you a greater than 10% payout on that money that you can't outlive. We can do a lot better with something like that than hoping that you're going to make that much in interest, because you won't. So you've got to look at both sides and say, what's best for me? What works the best for me for my whole life, and then make good selections and make sure that you pick top of the line products and not just the thing that pays somebody the most commission.
So there could be a place for annuities, not all are ripoffs. Craig, what do you think about, I'm going to be in a lower tax bracket in retirement, so it's best to contribute to defer taxes now and pay them later.
Maybe. So let's say that you're a high earner right now and you're in a 32% top tax bracket. Should you save money pre-tax or not? There's a battle right there because you're already giving up 32 cents on a dollar. So if you retire and the income that you will have is substantially less. We have a client, a couple of clients that came in, they make $380 between the two of them. Very, very good lifestyle. And they came to us and they said, we can retire on $125,000 a year. And I said, no, you can't. You're used to this. How can you go this much lower? It's a third. So we're having that debate right now. But if you are in a lower tax bracket for real, it's a good decision. But there's a lot of variables when you look at the White House and the Congress. What are these people going to decide is our tax rate in the future? And then you've got to be a realist. You look at our budget this year is supposed to be $7.3 trillion. Where does the money come from? They don't sell cars.
A product, right, yeah.
There's nothing that they have to offer. The money comes from you, ladies and gentlemen. It comes out of your wallet when you pay taxes. So if they need more money and they don't have the cash flow, what's your logical deduction? They will create a tax schedule that takes care of the costs needed from the U.S. government and the state. So if they raise the tax rates, that blows that idea all out of the water. You no longer have, because I earn less, I pay less. That doesn't necessarily mean that. And the other part is, take a look at inflation. My dad does this all the time. My first house cost $65,000. And I'm like, I hear you, Dad. It was a pretty nice house. Well, you couldn't even build the den in that thing today for that money, so stuff costs more. And if you are doing an assessment and doing analysis the way that we do it, we're going to look at your future and say, okay, you're 47 today, and it will cost $196,000 when you're 70 to buy the same stuff. You have a hard time getting your head around that, but it's several years down the road, and that inflationary expectation of what it's going to take to buy the same amount of goods and services, you need to look at that and say, maybe I won't be in a lower tax bracket because I'm going to need this much to survive based on the cost of groceries, the cost of health insurance, a new car every once in a while, and yeah, I'd like to travel and pay some money out and give my grandkids something. So you've got to look at it realistically.
And I'm going to add to that, Craig. It's not really an all or nothing. So you put everything in tax deferred, meaning pre-tax, or not at all. We're in the process, the first quarter of this year, talking with all our clients and looking at where are they saving, how are they saving, are there other ways to, in Jennifer terms, squirrel away money. So, even if you are contributing to your retirement account, are your spouse and your incomes low enough that you can go ahead and do a Roth contribution? So you can open up a Roth IRA, put that money, max fund that while you're still doing your 401k. So you're contributing in both ways. Your Roth is not going to be tax exempt this year, but it is tax deferred. And we started the show, I guess, last week looking at, starting that Roth clock now, because you have to have that Roth open for 5 years, be 59 and a half before all those dollars are tax free to you. So, I always look at where can you squirrel money away? What are the vehicles available to you at any given time to be able to create those nest eggs that you can then draw from in retirement? Because you're going to be able to, most people do save in a pre-tax. So when they look at that huge balance of $1 million, that $1 million isn't Jennifer Moser's, right? As that $1 million, maybe 65% is Jennifer Moser, 75% is Jennifer Moser, 25% is the government. So all of a sudden I've taken a tax hit. So you need to have those Roth dollars too, maybe your HSA, you can save in that. So you're able to manage that tax line. When you're in retirement, managing that tax line is so important to make sure you keep as much of your money as possible. So anyway, agree or disagree, Craig, you should never use credit cards. Never, never, never.
Well, that kills us, doesn't it?
Never.
This is a tough one in the modern world, right? Because there's so many things you can't do without one.
I don't see how you could do it.
Yeah.
Well, Dave Ramsey has a program that he says never use tax credit cards. And I can see that for the average person, because most people abuse credit cards and they run up bills. They use it for things. And therefore, they're paying huge amounts of interest to the credit card companies. So, but you can be smart with credit cards.
For sure.
And use those.
So it's a great tool. So the proper use of credit cards is basically you buy the things on a credit card, you get your 2 or 3 or 4 or 5% thing, let that cook, and at the end of the year, you take it out and there's your Christmas money. But if you instead just make a minimum payment or miss something by a day, and all of a sudden you're kicking out 29% interest, which is one that we just saw, paying 29 cents on a dollar on interest, you're buried. You got to get out of that thing. So understanding, can I control my spending? Do I understand what my line in the sand is because I have to pay it off at the end of the month? Or do you get a credit card that has a purchasing limit so they put some guardrails on it and won't let you do it? It just depends on it, but I don't see how you could rent a car, go on an air flight, do any travel unless you have a credit card.
Know yourself. When it comes to that one,
definitely
know yourself.
Yeah. We'd love to sit down with you and talk about these things with you. What are your opinions? Where do you want to be in retirement? And talk through, the decisions that you need to make. We don't always have the answers. We've just seen a lot of retirement plans and seen a lot of people wanting to make their dreams realized. I think we do a pretty good job helping them reach those dreams. We'd like to help you too. Number 336-448-1086.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086. Or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax Affiliated Insurance Agency.